Welcome back to the Investment Book Highlight Series. Today we are in London, England, overlooking the River Thames and Big Ben. I have Londoner Emily Abispa joining me. She has a doctorate degree in behavioral economics from the prestigious Oxford University. Emily, thanks for sitting down with me.
Thanks for the fabulous introduction, TJ. I'm looking forward to helping our audience gain an understanding of the book we are going to review today and perhaps inject some ideas of behavioral economics into the conversation.
Speaking of today's book, we'll be looking at Seth Klarman's Margin of Safety. It was published in 1991, and although initially a disappointment in sales, it has achieved a cult following. Emily, why don't you tell the audience what the book is about?
Okay, TJ, let me try my best. This book delves into risk-averse value investing strategies for the thoughtful investor. Klarman delivers practical insights for investors via the well-versed adage of buying securities at a discount to their current underlying value and holding them until their value is realized. I found it to be quite interesting since it relates to an economic principle called loss aversion.
Yes, I think Klarman does a fantastic job laying out foundations for buying stocks at a markdown so that we can limit risk. All right, let's get on with the top 10 jots. Emily, if you don't mind, let's take turns going over the key ideas from the book.
I don't mind at all. In fact, I think it's a wonderful idea.
The top 10 jots. Number 10. All market fads come to an end. Investors must never forget that Wall Street has a strong bullish bias, which coincides with its self-interest, states Klarman. More transactions are made during a bull market than a bear market, and those transactions influence the amount of income Wall Street workers receive. Security prices going too far up and then too far down is a cycle that often gets repeated. Before buying into a security, have a margin of safety to protect you from the downside risk. Number 9.
Acting with the crowd ensures an acceptable mediocrity. Acting independently runs the risk of unacceptable underperformance. Most money managers consider mediocre performance acceptable since they can satisfy most of their clients and keep retention rates high. Indexing guarantees matching the performance of the securities in the index, although it also guarantees not outperforming it. Klarman declares money managers are indifferent to whether the index rises or falls in value, other than to the extent that fees are based on total managed assets valued at market prices. In behavioral psychology, we call this urge to align ourselves with others, social norms. It is more powerful than most of us imagine because we're instinctively inclined to conformity.
Number 8. No one knows what the market will do. Trying to predict it is a waste of time, and investing based upon that prediction is a speculative undertaking. The two most common type of market players are the investors and the speculators. Investors usually buy into a great business that can generate cash but is being offered at a discount, while speculators play the greater fool game of buying overvalued businesses in hope that someone will buy it at a greater price. Klarman emphasizes, value investors are in a position to take advantage of Mr. Market's irrationality. Speculators mistakenly look to Mr. Market for investment guidance and buy high and sell low. Number 7.
Most of the major money management firms consider only large capitalization securities for investment. The flexibility of institutional investors is frequently limited by a self-imposed requirement to be fully invested at all times, even if substandard investments have to be added to their portfolio. Ample investment opportunities may exist in the securities that are excluded from consideration by most institutional investors. Mid and small capitalization securities offer investors a chance to buy a growing and emerging business that is overlooked and undervalued. This reminds me of ambiguity aversion, or uncertainty aversion, which is the tendency to favor the known over the unknown, including known risks over unknown risks.
Number 6. The opportunity cost of illiquidity is high. Most portfolios should maintain a balance of liquid and illiquid investments, opting for greater illiquidity when the market compensates investors well for bearing it. When your portfolio is completely in cash, there is no risk of loss. There is also, however, no possibility of earning a high return. Having liquid assets during a market recession or correction reduces opportunity costs, as bargains can be scooped up readily. Number 5.
Value investing offers a good possibility of investment success with limited risk. Investing into a security is usually better when there is inherent value in the current price. Buying at a considerable discount is the best way to ensure that you aren't overpaying. The best time to be a value investor is when the market is falling, so that you can seek the considerable discount that often besets itself. Value investing does entail risk, since risk is something that cannot be avoided, but it does try to curtail it by purchasing securities at a markdown. This is the cornerstone of prospect theory, which is a behavioral model that shows how people decide between alternatives that involve risk and uncertainty. It demonstrates that people think in terms of expected utility relative to a reference point, for example, current wealth, rather than absolute outcomes.
Number 4. Avoiding loss should be the primary goal of every investor. Klarman advises all of the following. Not losing money means that over several years, an investment portfolio should not be exposed to appreciable loss of principal. The actual risk of a particular investment cannot be determined from historical data. It depends on the price paid. Financial catastrophes can and do occur. Look at the Great Recession of 2008 and the dot-com bubble of 2000 as examples. Number 3.
Greater risk does not guarantee greater return. Klarman and Howard Marks both agree that risk and return are not necessarily positively correlated, and in fact risk can erode return by causing losses. In inefficient markets, it is possible to find investments offering high returns with low risk. We do not and cannot know all the risks of an investment, so we should strive to invest at a discount. The bargain element helps to provide a cushion for when things go wrong, claims Klarman. According to the efficient market hypothesis, the price or market value of a security reflects its true worth or intrinsic value. In a market with perfectly rational agents, prices are right. Findings in behavioral economics, by contrast, suggests that asset prices also reflect the trading behavior of individuals who are not fully rational.
Number 2. Business valuation. Investors should not fool themselves into believing they are capable of greater precision than experts when buying marketable securities based only on limited publicly available information, states Klarman. To perform a business valuation, you must predict the future, yet the future is not reliably predictable. This suggests that conservative projections and substantial discounts are the best way to invest in a business. An investor is better off knowing a lot about a few investments than knowing only a little about each of a great many holdings. Number 1.
A margin of safety is achieved when securities are purchased at prices sufficiently below underlying value to allow for human error, bad luck, or extreme volatility in a complex, unpredictable, and rapidly changing world, states Klarman. The cheapest security in an overvalued market may still be overvalued. The disciplined pursuit of bargains provides a margin of safety and a risk-averse approach. In behavioral economics, this relates to the power of free. A price of zero is much more attractive than any other price, no matter how low.
That's the top 10 jots from Margin of Safety by Seth Klarman. Thanks for doing the countdown with me, Emily.
You're welcome. I had a splendid time, and I hope your viewers could learn how basic behavioral economic principles can be related to investing.
I think the viewers can now see how human behavior affects their decision in making investments. I especially like the concept of herding, since that often influences security prices to be out of touch with reality. Alright, moving on. What do you, the viewers, think of Klarman's ideas? Put a comment below to let us know which were the most important for you. Emily, can you do the shout out for the beautiful images used in the countdown?
I'd be delighted to do it. A big thanks to Pexel.com for providing most of the images used. I really like the background here, since it is a beautiful photo of London. Have a wonderful day and see you next time in the Investment Book Highlight Series.